call the Federated Retirement and Healthcare Trust November meeting to order. Linda, can you take the roll?
Okay. Trustee Spencer Horowitz.
Present.
Trustee Julie Jennings.
Present.
Trustee Anurag Chandra.
Present.
Trustee Mark Kelleher. I did see him.
He is present. He just mute.
He's on mute.
Sorry.
Yeah.
Yeah, I was on mute.
Okay. And Trustee Elaine Orr.
Present.
Okay, we have a full complement. So I want to remind attendees that all chatter can be heard by the public, and we ask all speakers to clearly state their names for the record and for the audio recording. I want to remind all presenters to show their presentations on full screen mode. And it appears we are ready to move into closed session as the first agenda item. Is that correct?
Yes.
Yes, sir.
Updates have been made to the breakout rooms while utilizing Zoom. Staff is no longer able to put trustees in the breakout room the night before the meeting as they did in the past. To help make the process move smoothly, staff is asking for your patience as they let you into the breakout room one at a time. Also, if you plan to share your screen in closed session, please let staff know before going into the breakout room, and staff will make you co-host before you enter the room. This will take a few minutes. Thank you, and we will appreciate your cooperation. the open session. We are continuing to meet virtually at this meeting and are doing so pursuant to AB 361. As such, all votes will be roll call votes. If you are not speaking, please be on mute to cut background noise. For discussion items, each trustee will have a turn to speak in roll call order, more than once if desired, and the public will also have an opportunity to speak on each item after trustees. Public will also have an opportunity to speak again at the end of the meeting on any other item not on the agenda that is within the subject jurisdiction of the board. Orders of the day. I hope to take a break at around the 10 o'clock hour, and there will be a recess from 1 to 1:05 to accommodate the Civic Center TV broadcasting process. I'm asking all board members to please stay on the Zoom meeting call after the regular meeting ends for the public special meetings for each committee to address California Assembly Bill 361, which will take place using the same Zoom meeting ID and password. We need to waive sunshine on a number of attachments that were received late, and they include item 5C, discussion and action on the preliminary pension valuation. Item 5E, discussion and action on retiree member vacancy, municipal code section 2.08.1070. And item 6.3F, discussion and action on the committee recommendation to approve the Federated Retirement Plan's annual comprehensive financial report for fiscal year 2020-2021. May I have a motion to accept the orders of the day?
Sorry, Trustee Chairman Horowitz, do we need a motion to waive sunshine specifically as well?
Good question. Does anyone know?
I believe so. I was about to
Yes.
offer, I was about to offer a motion to waive sunshine on the items you listed.
Okay, well, let's do that then.
That would be appropriate.
So we have a motion from Trustee Chandra to waive sunshine. Is there a second?
This is Trustee Kelleher. I will second the motion.
We have a second from Trustee Kelleher. Is there any discussion? Hearing none, we'll have a roll call vote. Trustee Chandra,
Aye.
Trustee Orr,
Aye.
Trustee Kelleher,
Aye.
Vice Chair Jennings,
Aye.
and I vote aye as well, passes unanimously.
And then I will make a motion to approve the consent calendar. Trustee Chandra.
We're on orders of the day.
Sorry, I meant orders. I apologize. I meant orders of the day.
He wants to approve it all.
Omnibus.
So we have a motion from Trustee Chandra to approve the orders of the day. Do we have a second?
This is Trustee Kelleher. I will second the motion.
We have a motion and a second. Any discussion? Hearing none, we will have a roll call vote. Trustee Chandra,
Aye.
Trustee Orr,
Aye.
Trustee Kelleher,
Aye.
Vice Chair Jennings,
Aye.
and I vote aye as well. Chair Horowitz, it passes unanimously.
Mr. Chairman,
Yes?
at this point, it would be appropriate to report out of closed session that if I may, on behalf of the board, that they're coming out of closed session, there was no reportable action taken. Thank you, Mr. Chairman.
Thank you, Council Liederman. And now finally, we come to the consent calendar. Do we have a motion to accept the consent calendar?
Trustee Kelleher so motions.
And Trustee Keller, motion. Do we have a second?
Trustee
I second.
Chandra. Oh.
Yeah. No, it's
Trustee
okay.
Jennings.
We have Trustee Chandra as a second.
Yeah.
Any discussion? Hearing none, we have a roll call vote. Trustee Chandra,
Aye.
Trustee Orr,
Aye.
Trustee Kelleher,
Aye.
Vice Chair Jennings,
Aye.
and I vote aye as well. And I believe we are ready for the next item. Death and survivorship notification. We will observe a moment of silence for those who have served the city and who have passed. Thank you. Next item is item number 3, investments. We will hear from CIO Palani.
Thank you, Mr. Chairman. Good morning, trustees. Couple of things before we actually get to the one agenda item that we have today. Last Tuesday, I did present to the City Council our annual fee report, along with one of the trustees of the Police and Fire Board. And it was well received by the council. I think we've done a lot of education in the last 3 years on our approach, on our asset allocation, the reason we pay fees. Obviously, none of us like to pay fees, but sometimes we do have to pay fair compensation for services rendered. And I think the council's starting to understand fees is really a function of asset allocation. And to the extent that we can, we've tried to reduce costs and fees by negotiating with managers, by going to passive investments and so on. So that's something I wanted to share with the board. Secondly, fiscal year-to-date performance as of a couple of days ago. These are estimates from Makita. These are by no means final numbers. The Federated plan was up 4.35%, and the Healthcare Trust was up 4.09%. Again, these are estimates. With that, I'm actually going to move to the one item we have. There's an attachment here, which in a few minutes I'm going to try to open up. But before that, some background here. Chairman Horowitz and I had our meeting, our one-on-one meeting recently, and he requested that we talk about inflation. And I think it's very timely that we talk about inflation. Obviously, it's in the headlines every day. We feel it, when we go to try to fill gas in our cars. I just read yesterday that the average price of gasoline in California is now $4.68 a gallon, the highest it's been in 8 years. And every time I go to Whole Foods or Sprouts or Trader Joe's, I do feel the pinch. It's definitely way more expensive to buy groceries now than it was even 2 or 3 years ago. And also my favorite cup of hot chocolate at Starbucks is $4.25 now. It's such a ripoff, And at some point, this is called demand elasticity. And Starbucks is not. It's very elastic. I can be without it. At some point, and I'm not there yet. At some point, I'll just go to Walmart and pick up those 30 packets of Swiss Miss. Right? It's $5, and so I get 30 cups of hot chocolate for $5. So why should we worry about inflation? Inflation erodes, the purchasing price of your dollar, as we've seen with, that gallon of gas or that cup of coffee at Starbucks. It has an impact on the value of assets in our portfolio. So equities can go down. So again, if you had bought Starbucks in a share of Starbucks in July, when it hit a high of 126, now it's at $112, so you'd have lost over 10%. Clearly, Starbucks could not pass on those extra material costs to its consumers, because consumers are saying, I can live without that, right? Now, on the other hand, there are companies like NVIDIA, up 8% today, by the way, which actually makes graphic processing units for chips. And it's able to pass on its costs to its customers. So had you bought NVIDIA on January 1st, it was $132. Today, it's $317, up 239%. So it would have actually protected you against inflation, right? So some assets will do well in an inflationary environment, other assets will not do so well. So it's important to see how inflation can affect our portfolio, right? So I asked Veris to actually put together some slides, which they did. And I am going to try to share my screen now. Let's see. Can you guys see my screen?
No,
Okay.
We see the screen, we see you.
Thank you, Roberto.
You're welcome.
Yeah.
Okay, I'm going to try this again. Let's see, share screen. Okay, maybe Barbara can help me here. So it says basic, advanced, and files. And
If you're having trouble, we can ask staff to run it for you, but
Okay, all right.
whatever you choose.
Okay, all right. I hate to do this to staff, my apologies. But if you don't mind opening up that file.
nope, there we go.
No.
Perfect.
That was not me, right? No, it wasn't. Just curious. All right. So going back in history, right? I mean, so this goes back several decades. And you can see inflation over the past few decades. And obviously there have been inflationary periods in the last 100 years. Now let's go, but you can see the trend here is inflation has been going down in the past several years. And the last time we really had a nasty inflation shock of any consequence was 30 years ago. But that doesn't mean it won't happen again. And we've clearly seen the headline numbers. I mean, recently CPI came out, 6.2% annual number preceding 12 months. And we're all very concerned about it. So this is something that could happen again. But in the last several decades, we've not had any meaningful inflationary shocks. Can we go to the next slide? And this again shows inflationary periods over time. And next slide, please. And by the way, we have Eileen Neal here, Danny Sullivan from Veris. We also have Laura Wyrick from Makita, all our consultant experts who can also talk to this. So what I asked Veris to do is to run our portfolio through various inflationary shocks. You know, had we held this portfolio, the portfolio that we have today, how would it have performed under various scenarios historically? And as you can see, this is today's portfolio. In most scenarios, our portfolio has done well, would have done well. And I'll explain why in a little bit. But there are in some scenarios where obviously our portfolio has not done well. One is stagflation. And we'll get to stagflation in a little bit, right? But for the most part, it's done well. There was obviously the 73, 74 oil crisis when, you know, we would have lost some money. And then the 94 US rate hike when we would have lost some money. But by and large, you can see the various other inflationary periods when our portfolio would have done well. Can we go to the next?
Ask a question.
Yeah.
What is reflation scenario?
Yeah, so reflation is, so if we are getting into a disinflationary scenario, and I'll have Danny actually talk about the actual assumptions behind Bara's model here in a minute, but you try to stimulate the economy, right? And that's what a reflationary scenario is. When you actually have prices not going up and it's stagnant, that's not good either, right? You don't want some amount of healthy price increase. So when you're trying to stimulate the economy, you cut rates, for example, and you try to reflate the economy. Danny, do you want to, do we have Danny here?
Yep, I'm here, Prabhu.
Danny, there are some specific assumptions that Bara uses in a reflationary scenario, right?
Yeah, so we included a few of their more recent scenarios that they included for reflation. I can go over kind of the details there. So the assumptions that are made here, and apologies if this is too in the weeds, but the assumptions that are made there. So the break-even inflation rate at the two-year tenor is going up 75 basis points, and the 10-year would go up 40. We assume a slight shock in the treasury rate curve. Credit spreads actually narrow in the reflation scenario. So we're assuming that basically the Fed is doing a good job of managing inflation in the economy. Equities are going to go up. So US equity return is assumed to be plus 18% in the reflation scenario. And then the Euro USD, so there's a slight shock to currencies in that scenario too. So that's the reflation scenario.
Okay, so this is when the Fed's in there trying to correct or make adjustments to to
Yeah.
deal with inflation.
It's basically saying that fiscal and monetary stimulus are sized the right way to successfully,
Okay.
bring the economy back. So that's the idea there.
Okay. Thank you.
Thanks, Danny. So on slide 4, in one chart, you can see in various inflationary periods how the equity market would have done, how the commodity index would have done, and how TIPS would have done. And TIPS, as all of you know, are Treasury inflation protected securities. And the reason I show this in one chart is to just show the impact of inflation on various asset classes. Now, on the prior slide, you saw that our portfolio would have done well under most scenarios, not all scenarios. And what's the reason for that, right? The reason for that is today, our portfolio has about 60% exposure to public and private equity, right? That's a lot of exposure to equity. And we've seen, it depends on the kind of equity that you own, but there are equities like, I gave the example to make it very simple of NVIDIA, right? If you own such stocks, they will actually do well even in an inflationary scenario. So there are certain types of equities that will do well, right? Especially when you can pass on those costs to consumers. And as long as there's an expanding economy and employment is good, people have jobs, you can actually pass on those costs, right? And we also have some exposure to private real assets. It's about 5%. We have private real estate, which is 3%, core real estate, which is 5%, TIPS, which is 2%. So all of that is another 13%. So roughly, I would say about 70 to 75% of the portfolio today offers some kind of buffer in case of an inflationary scenario. Not all parts of the portfolio, but the majority of it. Now, what are the parts of the portfolio that will actually get affected in an inflationary scenario? So think about bonds, right? If there is an inflationary scenario, the Fed, it's likely that this Fed will hike rates. And when interest rates go up, bonds won't do well. Bond values will come down, especially long duration bonds. What do we have in the portfolio? We have about 2% long-term government bonds. They will not do well. We have about 8% in investment grade bonds, and those bonds won't do well. They'll actually decrease in value because even with investment grade core bonds, there's some duration exposure. We also have 5% in cash. Now, they won't necessarily go down in value, but the purchasing power of that cash will go down. So there are some parts of the portfolio that will get affected. But for the most part, about 70% of the portfolio, I think it's reasonably, it's a reasonable hedge against inflation that we have in our portfolio. Now, the other point I want to make about inflation, and we will have extensive discussions surrounding inflation when we do our next strategic asset allocation exercise, which is actually due to kick off in a few weeks, right? And this will be topmost in our minds as we think about our portfolio. The fact is, what the market does not like is surprises and shocks, right? Now, as long as people are talking about inflation and it's making the headlines, there is some kind of a self-adjusting mechanism in the market. So to the extent that people are talking about inflation, I'm actually less concerned about inflation. It doesn't mean that we'll get a free pass, but the fact is there's more of a gradual adjustment in prices that takes place. Now, we've all heard about the supply chain shock, right? And that there are supply chain bottlenecks, and that's driving up prices, which means, and if this is long drawn out, what's going to happen is eventually there will be more suppliers in the market, and that will have a natural downward effect on prices. And so to the extent that this is dominating headlines, I'm less concerned about inflation, but that doesn't mean that we don't have to be vigilant. We should be vigilant. We should be thinking about our portfolio at all times. I believe that's the last slide I have, and I'm happy to take questions and we can have a discussion on this.
Any questions from trustees? Prabhu, when you mentioned we're kicking off the asset allocation process in a few weeks, does that mean internally with staff or with the board or with the IC?
Good question, Mr. Chairman. What it means is really that the first step of the process is our consultant, Makita, will actually come up with capital market assumptions, and they revisit their assumptions every year, given what's happened in the market in the past 12 months and the current environment. So Makita will produce its CMAs sometime in January, as will Veris. And so that will kick off the process, and then staff will take a look at it, and Makita will run its optimizer, and staff and Makita will go back and forth on those capital market assumptions. And then this will be the second step of the process, is that we will then present this to the IC, to the investment committee, and we'll discuss various scenarios and combinations before it's brought to the board, typically in March or April.
And every year when we do that analysis, we include some inflationary scenarios, and so does Veris, but I imagine that we'll pay even more attention to them this year and make sure that they're pointed out.
Okay, thank you. Any other questions then? If not, thank you, CIO Pilani, and we'll move to the next agenda item.
Thank you, Mr. Chairman. I have to step out to get that expensive cup of hot chocolate.
I'm fine, Prabhu. I'll just have coffee.
Yeah. Think of all the money we're not spending by not having lunch together. So we're doing our part to fight inflation here.
Exactly right.
Next item then is, it seems to be no old business, new business. Oral update from the CEO, Mr. Pena.
Thank you. Thank you, Mr. Chair. If you bear with me for a few minutes, I have quite a few updates to give you. Let me start by addressing the two open seats, the retiree and the active seat that are open. The retiree update, I'm going to delay to later in the meeting under section 5E. So I'll address it at that point. I have some comments on that particular issue. In terms of the active seat, there's an election going on, and the ballots were sent out and they were due back to the clerk's office last week, November 8th. As we find out more about the dates, I will keep you posted, but usually what happens is the city clerk then goes to the process of counting the votes, and they'll have someone, they will indicate who have the most votes, and then they will go to the city council with the tally for the council appointments. So again, I will follow up with the city clerk, but I fully expect the city clerk to go to the city council in time to have a new active member appointed to your board for your December meeting.
Is it on the agenda for the city council?
It is on the agenda for which meeting?
That was my question. That was the lead-in question. Is it on the, I mean, there's only one person running, so I mean, it's kind of like obvious.
Yeah, no, I haven't seen the day, so I don't know the answer to that question, Trustee Jennings. I had to find out.
That would be a good thing to find out, because if they don't have it on the agenda, then we're not going to make December.
Understood. Yes. I fully expect that to be in one of the meetings early in December for the city council. But I'll follow up with the city clerk and see what information we get.
Thank you.
I also wanted to keep you posted. The city is continuing the process. They're on stage 2 right now, which means that employees were supposed to provide vaccination approved by September 30th. And if they didn't, then obviously either file an exemption under either medical or religious, or provide twice a week testing or negative testing. And so the city has continued that process. They are working on implementing a hybrid approach. Their goal is for the departments to sort of work to this process, and by January 3rd, the beginning of the year, they fully expect the departments to have their hybrid approach in place. And to that extent, I want to share with you that we had a quarterly staff meeting with our staff, as we do again every quarter. We do the first month of every quarter. Last was in September. And one of the issues that we discussed was a possible return to migrating back from remote work to the office slowly. I also, as you all know, I sent a communication to the staff, and I also shared the same communication with your board. But I wanted to also publicly to mention that our goal is to start having staff coming back to the office 1 day a week, starting with the November 29th through December. That's aside from the fact that the pensions group does have a benefit staff, one benefit staff every day at the office. We do have staff that is working the front desk to answer questions from members. And we are actually, in fact, making appointments for members to come into the office. So the office is not open yet, but when members call the office and they request an appointment, we are scheduling about 3 to 5 appointments a week with the benefit analyst. And so when they come in, they knock on the door, we open the office for them, and they meet with the staff. We do have, as you may remember, we do have an application that we are looking to roll out. I think that what we're doing is trying to get a sense of how these weekly appointments is working, so that we have more data and information, so that once we are ready in December, we can then roll this out, not only through the website, but that we will announce it to the members in our quarterly newsletter and through our various communications for social media like Twitter and Facebook. So the office is still closed, but we are accepting physical appointments. Of course, goes without saying that we are also having virtual appointments by staff with members when they request one. The goal is to eventually migrate from 1 day a week to potentially 2 days a week starting on January 3rd. I don't know if you have a chance to read lately, but I was quite surprised to read the last few days that there have been a sizable increase of COVID-19 cases in countries across Europe, and some countries are initiating again some steps to close their country. Again, I haven't seen any of that in the US or in the Bay Area, but the only reason I'm mentioning that is obviously the situation is still fluid, and those plans, obviously, if cases in the US and the Bay Area start coming up again, we may have to reconsider those steps. But at this point, again, we fully support remote work. We are fully engaged. We do have staff that comes to the office from time to time to do work that have to be done at the office. We are, to the extent possible, obviously taking care of our members, and we will keep you posted of any changes to that extent. Lastly, I wanted to give you an update. I mentioned last month that the open enrollment for health for retirees goes to the full month of November. Staff actually made a presentation to the San Jose Retiree Association earlier in the month of November. And so it's going, the presentation went very well. And in terms of the open enrollment, we have received about 350 change forms today. About 90% of those have been submitted electronically. The bulk of those changes, or the bulk of those forms, are really information to us to let us know that they will continue in lieu coverage, meaning that they're not making any changes. They have coverage in other situations, not under the city. They're just letting us know. The front desk is handling about 80 calls per day. Again, the bulk of those calls are for open enrollment, about 50 of them. The rest are for other kind of questions. And then we have healthcare staff that is handling, in addition to the front desk, handling calls on a daily basis, not only calls but emails. And I just want to take, it is challenging, especially doing it virtually. And so I want to take this opportunity to publicly shout out the desk team. that is doing a fantastic job and fielding all the questions, whether they're either by phone or by email, and to the healthcare staff also because of the open enrollment and fielding all those questions and everything else. And in general to staff, making themselves available. We really haven't had any issues with making sure that we have a benefit analyst here on a daily basis. Every day is a different benefit analyst, but we always have someone on board so that we can take those appointments that we are scheduling week in and week out. Mr. Chair, that actually concludes my comments. I'm happy to, one last, we did issue the quarterly newsletter. I just wanted to let you know there was a bit of a mishap for whatever reason. The ones that we sent out on email were fine, but the vendor that we used to send the newsletter, apparently, I don't know the reason for it, but they actually reissue, they mail out the newsletter from the prior quarter. So if some of you get the newsletter by mail, you did receive the last quarter newsletter again, and they quickly notify us that was the situation, and they reissued the new newsletter, which should be in most people's houses by now. But just wanted to mention in case you heard from a member indicating that they got 2 separate newsletters this time around. And with that, I'm happy to entertain any questions that you may have. Thank you, Mr. Chair.
Thank you, Mr. Pena. Any questions?
I have a question. I'm just curious. You mentioned, I assume this is the active retirees who are changing their health care options. So if they go and choose in lieu, I assume they can do that, but they don't lose their option to come back.
That's right. The in lieu is a process by which you let us know that you're not using the coverage, and so we keep track of that. There is a credit that they gain every year, so that when they're ready to use it, then they can use that credit for the costs associated with the coverage. Yes, they are required to keep us apprised, and that's the reason why they need to let us know.
Okay. Interesting. And also with just, I've been staying abreast of the whole, what's happening in Europe, also what's happening in the US. Right now, California looks pretty reasonable in cases. However, it is running rampant, in the north a bit, and, some of the other areas. So it's quite possible. We tend to do that as a, we want to bring back the office and people coming in and having those options. It seems like over the year, as we've done that, we keep on pulling back, because then that's when the virus takes off again. So it'll be interesting to see what transpires as we get closer to January. Just commentary, not a question on that one.
Any other questions from trustees? Mr. Pena, with respect to the election of the employee representative, is it correct that there's only one applicant then?
That is my understanding. There was only one applicant, so I fully expect that applicant to be elected. What I'm missing is the actual, the deadline to return the ballot was, I believe, November 8th. I just haven't heard from the city clerk as to when she plans to, I think the word is to make it official, the election, and bring the results to the city council for the appointment. And I need to follow up on that. But again, because your meeting in December is the 16th, we're hoping that there is time for the city clerk to bring this forward to the city council in time for council to appoint the acting members for your December meeting. And
is city council approvable a foregone conclusion, or could they reject the candidate?
Oh, well, they could always reject the candidate. Usually I would say, I will defer to obviously council member Davis, but that's always a possibility. But I would say, especially because of an active member election, unlikely as the person will be elected, but that's why it goes back to the city council, right? Because they have the authority to appoint the person, yes.
I see, okay. Thank you. Any other questions? If not, thank you, CEO Pena, and we'll move to item 5B, oral update from Councilmember Davis.
I didn't see her in the.
Mr. Chair, I do not see her.
I see. Okay.
I will
guess-
send her a text.
All right, we can move on and then return to item 5B then?
Yes, that would be fine, Mr. Chair.
Okay. So, well, I see it's about 5 to 10. Maybe at this juncture, it would be a good time to take a 5-minute break and reconvene at 10 o'clock. So let us pause here and resume our deliberations at 10 o'clock. Thank you. resume our proceedings. I'm just wondering if Council Liaison Davis is present for item 5B.
She's still not here.
Still not. Okay, so let us move on then to item 5C. Discussion action on preliminary pension valuation and economic assumptions by Chiron. I believe Mr. Hallmark is here to present.
Good morning, Mr. Chair and trustees. Let me share my screen here. All right. So we are here to present the preliminary valuation results for 2021. I just wanted to remind people where we are in our schedule of actuarial presentations. We're a little bit ahead of our normal schedule because we're trying to accommodate the actuarial audit here and make sure that there's time for everything. So last month, the board approved the economic assumptions for the pension plan. And so this month, we've got our draft pension valuation results. So there's not a full report and just a preliminary presentation. We're also going to review the assumptions for the OPEB valuation in the next agenda item. And we need the board to adopt those assumptions so that we can proceed with that valuation. In December, we will come back with the final pension valuation report and an updated presentation with more projections. We'll also have the draft OPEB valuation results. And then in January, we understand SEAL will present their audit results on the pension plan. At the same time, we will present the final OPEB valuation report. And then finally, at the February board meeting, we understand SEAL will present their audit of the OPEB valuation. So it's the beginning of a multi-month process here, and just wanted to keep everyone on track with what's on the schedule. For the for a pension plan and pension valuation, there are adjustments that go on constantly in the system. The benefits change as people retire, depending on how long people live, salary increases, and so forth. The investment returns are constantly changing. And as Prabhu was just talking, the board reviews the investment allocation annually. So there are tweaks that happen there all the time. The valuation is really focused on the contributions. It's our annual time to check the contributions, make sure they're sufficient, and make adjustments as necessary. This valuation will set the contributions for the 2023 fiscal year. So there is a delay between the valuation date and when the contributions change. And we go through the process by first projecting out what benefits we expect to be paid in the future. We use actuarial cost methods to set a funding target that we call the actuarial liability. And then from that, we apply the board's policies and set employer and employee contributions. In the end, we have to make sure that the contributions plus the investment earnings will pay for all the expenses and the benefits. So that's the process we're about. Here are the preliminary funded status results. The chart on the left shows the liability, the actuarial liability, broken into 3 different groups. The blue bar is the liability for members currently receiving benefits. The gold bar is for members who no longer work for the city but haven't commenced benefits. They're entitled to benefits in the future. And the red bar is the liability for the active members. And so you can see the liability increased as it normally does from one valuation to the next. The other thing to note here is that about 70% of the liability is for members who are currently receiving benefits. And only about 30% or less than 30% is for people currently working for the city. The teal line represents the smooth actuarial value of assets, and the green line represents the market value. So you can see that the market value started out below the actuarial value in 2020, and then the exceptional returns we had this year increased it substantially, but the actuarial value goes up more slowly. And Stephen will go through that calculation a little bit later in our presentation. We're showing the funded status for the system at the top, increasing from 52% to 55%. That's based on the actuarial value of assets. On the market value, we're about 62% funded. The chart on the right breaks the numbers out between Tier 1 and Tier 2. AVA stands for the actuarial value of assets and MVA, the market value. So you can read both of those numbers. Based on the actuarial value, there's still about a $2 billion unfunded liability in Tier 1. It's $1.7 billion based on the market value. In Tier 2, the numbers are much smaller, but we should note that on the market value basis, Tier 2 is about 109% funded now. On the actuarial value, it's still below 100% at 95%, but it's much better funded, but the values are much smaller. This chart shows the contributions both as rates as a percentage of payroll on the left and amounts on the right. We break the contributions into some different components. So the light purple is the member contribution, and this combines Tier 1 and Tier 2. And then the dark purple is the city's normal cost. So the normal cost is the cost of benefits attributed to the next year of service. And so those are the benefits that are being earned today by active members. And the total normal cost is the combination of the two purple bars. And you can see it has declined slightly as a percent of pay, increased a little bit as a dollar amount. It's declining as a percent of pay as we shift from Tier 1 to Tier 2 members in the active population, because Tier 2 members have a lower normal cost. The dark and light gold bars are the payments on the unfunded liability. And so you can see the payments on the unfunded liability still dominate the contributions. The dark gold is what we pay in interest on the unfunded liability. We calculate interest using our assumed rate of return of 6 5/8%. And then the light gold bars are how much we're paying down in principal. We calculate the interest based on the unfunded liability using the market value of assets. So the interest on the UAL dropped significantly this year with the exceptional investment returns. That allows more of the contribution to go towards paying off the principal. As a rate, the city's contribution rate has dropped a little over 2% of pay. But as a dollar amount, it's going up about $2 million. And this is a little higher than what we showed in our earlier projections. We did have some actuarial losses in the demographic experience that we'll go through shortly. So with that, I'm going to turn it to Stephen to take the next section.
Good morning, everyone. So on slide 6, we show a history of membership counts, and you can see the green at the top is members in pay, so currently receiving benefits. There are deferred members, so members that no longer work for the city, but are due a benefit later and will commence at some point. And then there are 2 shades of blue for active members, with the light blue being the tier 2 actives that come in on, later in the progression here. But that one thing to note, well, before I go there, there's also a red line, the support ratio. And what that is the number of inactive members, the ratio of inactive members to active members. And what you can see is that really jumped around the time of the Great Recession. And what caused that was a large reduction in active membership, which you can see in the blue at the bottom. And in addition, tier 2 came in and shortly after that time. And you can see that the light blue, how the tier 2 membership has grown, but that the total active membership level is not quite back to where it was at the start of the Great Recession. And so if we look at the far right, 2021, the total membership, as folks have retired and new employees have come on, total membership is right around 10,000, with 4,500 of that being in pay, 1,600 being deferred, and then the rest being active, with roughly 60% of those actives are tier 2. Now we'll see later with Jackie's slides that the liabilities don't look the liabilities are very different for those 2 groups. But now there are roughly 60% of the active population is under tier 2. And the support ratio, again, has gone up over the years as more folks have retired, but it has stabilized since leaping up around the Great Recession.
If I might add a point, is that okay?
Sure.
Okay. In looking at this, it just occurred to me that, so we're counting the people that are actually paying into the system. Is that correct? Those for the actives?
Yes.
Okay. Because we have in the city a large vacancy rate, right? So these are positions that are budgeted, and there is a budget, but we don't have people in those positions. So thus they're not paying into the system, right?
Right.
And so if the city were able to get to a 2% vacancy rate, which is kind of what they budget, we might see the support ratio get better or become less, it might go down a bit, because there are, I think, about 700 vacancies or so.
Oh, okay.
And it just might be an interesting thing, it's just interesting to keep in mind. It truly is based on the ability to hire, which has been kind of a challenge that our sponsors had for quite some time.
Yeah, and I would know that the support ratio in and of itself, it's not saying that it's not a bad thing to have that being over 1. I mean, that's very common with mature plans.
Mm-hmm. But more people paying in, that would be a little better.
True.
Right.
Yeah.
So moving on to slide 7, we thought we would run through a bit of the the development of the actuarial value of assets this year. And on the left side, we're showing that the pieces that sort of the underlying mechanics of how the smoothing process works. And what we show on the right side is the actual return on assets versus the expected return on assets. So the expected return is based on, the plan's assumed rate of return. Is also used for discounting future benefit payments, and that is currently 6.625%. And you can see in the blue, the blue bars are the expected return. So that's based on again, that expected return. And you can see that those are fairly stable, 130 million to 150 million. And what fluctuates is the actual return on assets, the green bars, and those, the returns come in either higher or lower. But what you can see is dominating this chart here is the 699 million actual return for fiscal year ending 2021. So that, and the scale's from 0 here, but it really stands out. So that's, obviously exceptional returns, as Bill mentioned. And what that does is it creates a large deferred gains, and we can see how that works on the right side here. So on the right hand chart, we're showing the recognized and deferred investment gains and losses. And what we do is we look at on the left side, the blue versus the green, right? So the difference between the actual and expected. So that's your gain or loss. And then a portion of that is recognized each year. So 20% each year with the 5-year smoothing. So if we look at 2017, the entire 15 million, which was a gain, has been recognized. And then 2018, 80% of that $23 million loss has been recognized. 2019, 60% of the 68 million loss, and so on, 80% in 2020. And then 2021, there's a very large deferred gain, because only 20% of that gain has the difference between the 699 and the 151 has been recognized. So only 20%. And on the next slide, we show some numbers, but that's graphically what's happening. So here on the left side, we're showing the numbers behind that. And I guess what I'd like to focus on is, at the top, we show the market value for both tier 1 and tier 2, and then in total. And the rows there show the different pieces and the amount that's deferred. Obviously, at the top, the fiscal year end 2021, those are the large items. So 518 million loss, 80% deferred, 415 million on tier 1, 22.9 million deferred on tier 2, and so on down. Where if we look at the bottom 2 rows there, the total of the deferred amounts the total is 350 million on tier 1 and 20 million on tier 2. So the difference between the top right, your market value of assets as of the valuation date, and in the bottom right, the actuarial value of assets, is that 371 million deferred. And graphically, we show that on the right. You can see that the smooth value is shown in green. The market value fluctuates a lot more. Market value is shown in blue. And this is a good illustration of the smoothing mechanism doing its job, right? So there's a smoother curve there, which the purpose is to have more predictable and smoother contributions. But you can see there's quite a jump there and we have zoomed in a bit, so this exaggerates the jump a little bit, right? Because we're starting the scale at 1 billion, but there is, again, 370 million that is going to flow into the actuarial value of assets over the next 4 more years. So even you would expect asset gains even if the return was exactly met, right, on the actuarial value. Again, the actuarial value is currently significantly lower than the market value because of this smooth mechanism.
Just want to add a point. I think that's a good chart. I like that chart. So it kind of encapsulates the piece. Just wanted to say.
Okay, thank you. So now that we've covered the assets, we're also going to look at the liabilities. And on the left side, we're looking at the unfunded actuarial liability. So that's the gap between the assets and the liabilities. And this is on an actuarial basis. So, and again, we've zoomed in on the scale here, right? Because these items are pretty small compared to the total liability and even the unfunded actuarial liability. But we do want to show, what took place during the year. So that the unfunded actuarial liability started out at 2.1 billion the prior year, and then we're showing the components here. The first being in red, contributions. So that is contributions in excess of what we call the tread water amount, which is basically your normal cost of the benefits accruing during the year and the interest on your unfunded. So any contributions above that level will reduce the unfunded actuarial liability. So that's dropping by 14 million due to contributions. The second item is the largest, that's investment gains. And again, this is on an actuarial basis. So there's 76 million there in investment gains, decreasing the unfunded. After that, there is a 20 million or $28 million increase due to liability experience. So that includes, several components: retirement, mortality, different pieces that we'll look at on the next chart. But there was also an assumption change of 10 million. And you might be thinking, well, hold on, we didn't change any assumptions. But there is a policy to use the latest mortality projection scale from the Society of Actuaries. So that gets released each year. And this year, it actually resulted in a small increase in liability. So about 10 million there. Whereas in prior years, that's typically been a small reduction because the initial MP scale was a bit conservative, it turns out. But 10 million is not a large increase in liability relative to the plan for the new scale.
So Stephen, that kind of surprises me that mortality rates would have decreased given the health issues that face the nation and the world this year.
Yes, that is an insightful comment. Now there is a lag. So next year when MP 2022 comes out, we might see some difference there because of the COVID. So I don't think the COVID would yet be having an impact in the data. So
yeah, so the projection scale model is based on actual mortality improvements up to a certain point, and their latest data is 2019 data. So it doesn't yet reflect the impact of COVID. They did comment that they don't know how they are going to reflect COVID when they issue the scale next year. Because the question is, do we think that is a long-term impact on mortality or a short-term impact? And so how should that affect our projection scales? There may be, we will definitely see some adjustment, but it's hard to know whether it's going to just snap back to the improvement levels we had before or continue for a longer time.
Great. Thank you very much for that.
So the sum of these pieces overall is a reduction in the UAL from 2.1 billion to 2.047. And again, part of that was liability, changes in liability. And so on the right side, we're showing liability gains and losses. And we're showing 5 years. And you'll see the line shows the aggregate impact each year, with there's the center line being 0. So anything above 0 is increasing liability, and anything below 0 is decreasing it. And you'll see salary increases in green have mostly increased the liability, although not every year. And on the we have yellow, which is retirements. So this is actual retirements versus expected. Those have increased the liability every year. Termination has increased in most years. So that would be, yeah. So that's the rate of people leaving being different than expected. And then mortality has sort of gone both directions. That's the actual experience. And we'll talk a little bit about the most recent year's mortality experience in a couple slides. And then disability is sort of pretty negligible, hard to see there, but that's in dark blue. So, and other, you might notice there's a fairly large other in 2019. That was a one-time data cleanup project that the main item that reduced liability was cleaning up some of the data in terms of retirees currently in pay, whether their spouses were deceased or not. So if someone's currently in pay and their spouse is actually deceased, then you can treat them as a single life annuity rather than a joint and survivor annuity. So cleaning that up there's a significant reduction in liability from that.
How does Office of Retirement Services receive this information? If a spouse were to die, I mean, is that the responsibility of the retiree? I'm just curious.
Yes, it is the responsibility of the retiree, although that does not mean that we do our own checkup. We do have a vendor that through Social Security information provide us information. If I'm mistaken here, Barbara, please correct me, whether it's monthly or quarterly. So we do have some ability to sort of check on that, but it is ultimately, the responsibility of the retiree to let us know that the person has passed away. I just wanted to also mention two things. Number one, the cleanup, you may recall that we were the implementation of the new administrative system, and that require a lot of data cleanup. So I'm not suggesting that that's related to that, but I will assume that part of it is related to that cleanup. And lastly, I don't want to confuse the chart on the left with the chart on the right, because your liability can be going up, but your unfunded can be going down. So if you look at it initially, you could be looking at it like, why is the liability going up on the right when the unfunded liability is going down? But that's because your assets went up too. So your unfunded liability can be decreasing even if your total liability is actually increasing. Does that make sense, Bill?
Yeah, the chart on the right is just zooming in on this liability experience item here. And so that matches the 2021. And then we're just giving some history of that item. And so the scale here is also important. The liability changes are usually in a much narrower window than the investment gains and losses.
And so I guess we do just that because that's the one that have the different impact, right? Investment gains is very straightforward. Either you assume great return or you do not. And the assumption change, obviously, was explained, which have to do with the table. So the only one that really has the different variables is the liability experience, which is why you're showing that on the right-hand side.
Right, and that really drives, or it's an indication of how well we're doing with our assumptions and what we might need to change in the future. Stephen mentioned how salaries have been higher, but then they were lower in 18, higher in 17. what we don't expect to be right every single year. What we want to see is kind of a balanced pattern. And then when we do an experience study, which I think is 2 years away, then we revisit these assumptions and adjust. And so this just gives you kind of an early indication of what we might be looking at with the next experience study.
Fair enough. Thank you very much for that information.
Okay, so because of the pandemic, we get a lot of questions about mortality. And so we thought we would look at sort of what's happened in the US and then look at what happened in the Federated plan specifically this year. So on the left here is an analysis done by the Society of Actuaries on data in 2020, looking at mortality rates and how they changed during the pandemic. And so the red area shows the increase in deaths due to COVID. And not surprisingly, you can see the relationship with age that we've all heard reported in the news, that it was particularly hit older people. And so those over 64 experienced about a 18% increase in mortality rates across the US due to COVID. The thing that was interesting in their study was looking at all the non-COVID related deaths and the excess rates. And that resulted in across the board over a 20% increase in mortality rates. Now, the younger groups, there's a lot fewer deaths, so an increase in rates still doesn't produce the same increase in the number of deaths. But it was interesting to see this, and that when you combine the excess COVID deaths and the excess non-COVID deaths, the group that was most affected was the 35 to 64-year-old group. So the society didn't delve into what's driving these excess non-COVID deaths, but there was a presentation in an actuarial meeting that referenced a study that was published in the Journal of the American Medical Association. And so I pulled up that study just to get a sense of what's going on. And keep in mind, both of these are only looking at 2020, not 2021. So the story is a little incomplete here. But we saw increases in deaths for a variety of causes. Heart disease is one of the largest, largest causes of deaths. So 5.6% increase, that is a lot of people. The others, we saw increases in sort of chronic conditions, except for lower respiratory. I should note here that accidents being up 13%, that includes drug overdoses. So I think that's probably a significant portion of that. But I think it's too early to draw too many conclusions from this data, but I thought it was interesting, both that we're experiencing a lot of non-COVID deaths and then what those may be. When the Society of Actuaries published the new 2021 mortality improvement scale, they provided this table showing weekly excess deaths in 2021, which clearly follows the pattern of the pandemic, where we had very high rates of COVID in the winter last year and spring, and those came down and then returned again this fall. So this data has not been incorporated in a lot of the studies, but for our evaluation, we covered the period to June 30th, 2021. So looking from July 1, 2020 to June 30th, 2021, we thought we'd look at what happened in your plan, because obviously the impact of COVID varied a lot by your community. So here we're showing the black squares represent the expected number of deaths for each of these populations: active employees, retirees, disabled retirees, and beneficiaries. And the gold diamond represents the actual number. And then the gray bar is our 90% confidence interval. And so it would only be if actual deaths were outside that gray bar that we could conclude conclusively that there was an effect during the year. But in fact, the actual number of deaths almost hit exactly as expected for the federated system. So there could have been a COVID effect, but we're really not seeing a COVID effect in the data for the federated system, which is good. But we'll
keep. Is it typical that you're so spot on?
Well, for larger populations, we tend to be more spot on. When I've looked at it for smaller plans, it varies a lot. But this was really spot on.
I know, yeah.
I think that's just some luck, I guess.
Okay.
And I would say, for most of the plans I've seen on the West Coast so far, we're not seeing a dramatic impact from COVID. Some of the plans that I don't work on many plans on the East Coast, although I did do one large one in New York State where we did an audit, but it only covered 2020 and not 2021. And so there was not a large impact there. But we have seen some plans that have a much more significant impact. But this is fairly typical so far from what I've seen on the West Coast, that we're not seeing a discernible impact of COVID on plan participants. So I'll turn it to Jackie.
Okay. So in this chart, we're looking at the historical change in the UAL. So in the earlier part of the presentation, we focused on investments as one part, and we focused on liabilities as part. This is them combined and the effect that they have on the total unfunded actuarial liability. So this is historical. So each color of the bar represents a different portion of it. And the line represents the net change, so the actual change to the UAL for that year. So if you look at it, what's pretty significant is out of the last 10 years, 9 of them, you saw an increase in your unfunded actuarial liability. But with the great investments over the last year, finally in 2021, you saw a decrease in that. It's finally below zero. If you look at that negative 53.3 million. So also looking at the different chunks of it, the biggest portion that's added to your UAL over the last 10 years has been assumption changes. So discount rate changes, that's been a big driving force of it, lowering your discount rate. So in total over the last 10 years, you can see that the assumption changes have added $501 million to the UAL. So that's almost half of the total increase of $1.1 billion. The next biggest driver is your investment gains and losses. So investments, they have accounted for about 416 million of that increase. So you can see those are your two big driving factors that are affecting your UAL from each year to each year. But the great returns over last year only put you in the black, so that was a good sign. So There's no questions on that. We'll move to looking at tier 1 versus tier 2. So if you remember, tier 2 got added in 2012 of the plan. So it's been around for about 9 years now. So your tier 2 population in the plan, those account for people that have been hired since there. And it's actually quite a big population of your plan now. So if you look at the green parts of these two pie charts, those are attributable to tier 2. Those are your actives and your vested terms. You've got one retiree right now in tier 2. And then the blue parts are for tier 1. So you can see as far as counts go, tier 2 accounts for about a third of your population now. But regarding payroll, they're actually almost 2/3. They're accounting for 58% of the total payroll for active member population. But in the next chart, you can see what portion of the liabilities and the assets are attributable to tier 2. And you can see that it takes a much longer time to build up the liabilities and the assets for that group. So even though they're a big portion of your total population, your active population, you have to remember that in tier 1, you still have all your inactive population. So for tier 2, they're only accounting for about 3% of the total liability right now and only 6% of your assets. So there's still a very small portion of those numbers of the plans. The next slide, we look at the contributions and the breakdown of them between the two tiers. So you can see that your tier 1 contributions are far higher than your tier 2 contributions right now. And the biggest part of the tier 1 contribution is that UAL that the city is paying down. So you can see that still accounts for about over $162 million right now. But as far as tier 2 goes, which are those two smaller bars, you can see that the UAL payment is that city UAL payment is very small. And the majority of those tier 2 payments are coming from your normal cost contributions. This shows the 5-year contribution projections of the plan. You can see that it's actually a very good outlook. Over the next 5 years, you're expecting your aggregate city contributions to decrease, as well as the aggregate contribution rate. So this is pretty significant. It's really attributable to those great investment returns that have paid off a whole bunch of the UAL. Excuse the noise in the background. Murphy's Law is always going to happen. So just wanted to point out, in comparison to last year's projections, when we showed this to you last year in 2026, we had expected the aggregate city contribution to be over $230 million and close to 59% contribution rate. And it's gone all the way down to 48.66%. So it's a great change in the projected contribution rates. So the only thing that could really have a huge impact now is any significant losses from liabilities or investments.
Yeah, so are there any questions? We will be coming back next month and show some sensitivity in different scenarios for contributions going forward so that you can get a sense of those risks. But these are we don't expect these valuation results to change, but they are preliminary, sort of pending the results of the audit.
Any questions from trustees?
No, that looks good.
Yeah, no questions for me. Thank you for the presentation. Very informative.
Thank you, especially for the reference back to prior year. Just having that pre and post comparison is helpful.
Yes, thank you so much. Very comprehensive. And it's always good to hear a little bit of good news. So,
Mr. Chair, I think it may be helpful if the board actually take action on approving the evaluation results for the June 30th, 20.
Even though they're preliminary, Roberto?
Well, Bill,
I see
you bring
that.
it the
Yeah, I
next
see that.
month. Go ahead.
No, I see that action is requested in the agenda. I just was clarifying.
You expect these results to be different for the evaluation report?
No, we expect these results to remain the same, but you don't have the full valuation report yet that you would normally accept as approval. You will have that next month.
All right. I mean, I'm fine. I just see the action item on the evaluation results. I'm fine either way. That's quite all right. I think your point is well taken. They can always approve the final report next month.
It seems to me we should vote on the final report, and that would make most sense. So
I tend to agree with Chair Horowitz.
That's quite all right.
I'm with you because I'm confused as to what we would be approving right now. As I look at the summary recommendations, I think we'd have to dive into those specific categories a little further.
Okay, then I think we'll move on to the next agenda item.
Okay, is the different PowerPoint showing? No, let me. Okay, so we're going to switch gears to the OPEB valuation, and Mike Shunning, our healthcare actuary, is going to join me for the presentation. I'll cover the first part, and he'll take you through the second half of the presentation. Wanted to start this by, we've been talking a lot about pensions, and the OPEB is a slightly different animal than the pension plan. So want to spend a little bit talking about the OPEB plan and reorient before we go through the specific assumptions. So the OPEB plan is mostly a closed plan. Technically, it's not closed because all members can get benefits if they qualify for a catastrophic disability, but only the tier 1 members who did not elect to join the VEBA can get the full retiree healthcare benefits. And so it's mostly closed to those members. And those members pay a fixed contribution of 7.5% of pay. So if you think back to that tank chart where we had values for both the employer and the member contributions, in this case, the member contribution piece is just fixed, and we are not changing it. The city contributions are set by the board, and so that's the piece that we will be adjusting in the valuation. But there is a slight twist to it here, in that the city has the option to cap their contributions at 14% of pay. That has not been an issue. The contributions are well below 14% of pay, but there is that cap going forward. Again, we use this valuation to set the city's contribution for the 2023 fiscal year. We also use it for the financial reporting, both for the plan and for the city, that we complete in September of next year.
Bill, I have a question.
Sure.
The city can cap contributions at 14% of pay. If it was, 15 or 16, and the members' contributions are fixed at 7.5, then what happens?
Well, the city can contribute the amount that we tell them at 15 or 16%, but they have the option of limiting that contribution to 14%.
Well, then it's not funded, right? It starts getting an unfunded. I mean, what happens?
Potentially it does. It may be that the difference between 14 and 15 is not a big deal, but if it grows over time, that could be an issue. We aren't projecting it to be an issue at all for this plan.
Okay.
But
would it not simply add to the unfunded liability for the OPEB?
it would if the city did not make the contributions.
Right.
Right. Okay.
Now, with the OPEB plan, it also gets confusing because there are two separate subsidies going on here. There's the explicit subsidy, which we pre-fund, or the city pre-funds and is in the 115 trust, through the 115 trust. And that's really what we are focused on in terms of setting the contributions to fund that explicit subsidy. The explicit subsidy is based on the premium for health coverage that a retiree selects up to 100% of the premium for the lowest cost plan offered to active employees. So it's really based on the lowest cost plan offered to active employees. And that's the subsidy that's provided to retirees that we are focusing on funding. Now, the implicit subsidy is funded on a pay-as-you-go basis. And the implicit subsidy is the difference between what we expect for retiree claims costs and what the premiums are. And so healthcare costs vary by age, and the premiums are set uniformly across for pre-Medicare retirees, across actives and pre-Medicare retirees. So you can think of that premium as kind of representing the average claims costs. But for the retiree group, that claims cost would be higher than the average because they tend to be older than average when you include the actives. So the city effectively pays for that subsidy as a part of the premiums it pays for active healthcare. Because if it was not including the retirees, the premiums for actives would be lower because the average healthcare cost would be lower. So we develop an expected claims costs using combined data for Federated and police and fire. We disclose the value of that implicit subsidy in the funding valuation, and in the financial reporting valuation, it's a critical part of all of the financial reporting. But because we're not trying to pre-fund it, the funding valuation mainly just focuses on the explicit subsidy piece. So that's the last thing I'm going to say about the implicit subsidy. We don't have updated valuation results. We're just starting the process for the OPEB plan, but wanted to remind you where we were with the last valuation. And so this is just from the last valuation. And there are a couple things I want to point out here. First, on the contribution side, let's remind you of the scale here. The city's contributions are the gold, and they're about $20 million compared to $200 million for the pension plan. So we're talking about a much smaller liability and a much smaller contribution. The members are contributing about $9 million. And that actually is covering more than the total normal cost. The total normal cost is around $6 million. And so members are helping to pay part of the unfunded liability with their contributions. On the right-hand side, we use the same breakouts we did on the pension, where the blue bars are for those who are currently receiving benefits, and the red is for actives, and the gold for the deferred. So again, most of the liability is for current retirees. And because the plan is primarily closed, we would expect that proportion to increase over time as people retire. We just use a market value of assets for this plan. We don't use an actuarial value. And instead, we have built in a smoothing mechanism in the amortization method. And that's partly because for an OPEB plan, in addition to the assets being volatile, the liabilities are somewhat volatile.
On this chart, you are showing on the right-hand side, 2019 and 2020.
Right.
Okay.
So we are not showing the exceptional returns yet. So we would expect this green bar line to increase significantly. And then we'll have to see what happens with the liability. And I'll give you a hint of that on the next slide. But as of 2020, we were 54% funded for the OPEB, which is about the same as we were for the pension. And that's pretty unusual. Most OPEB plans around the country are much more poorly funded because they did not start funding until relatively recently, whereas pension plans have been funding for a long time. This plan has rapidly increased its funding percentage, both with changes to the liabilities and with increasing contributions and building those up. The other thing I wanted to point out is we mentioned the city's optional cap. For 2022, the cap would have been about 47 million compared to a $20 million contribution. So we're a long ways from that cap applying.
Just one more question, Bill, sorry.
Sure.
When you're talking about member contributions, are you talking about active members or in pay members? I mean, they
good question. Good question. Here we are talking about active members' contributions that go into the trust. Retirees also are paying a portion of their premium, or maybe a portion of it, depending on the plan they elect. And those contributions are not included here. These contributions are just the contributions going to the trust.
I see. Okay.
These were the projections from the 2020 valuation. So you can see we were expected to get to 100% in 2038. I expect with the investment returns, this will have changed as we move forward. So we will be bringing that back with this valuation. On the bottom chart, you can see we had from 2012 through 2018, before the VIVA was set up, we had substantial contributions both from employees and the city that were increasing. And with the changes, the contributions dropped, the liabilities dropped, and we're looking at fairly level projection of contributions for the city, increasing from about 20 million to 23 million until they reach full funding. And because it's closed, the member contributions are declining. It's the same percentage of payroll, but expected to decline. In the background here, the gray is the expected subsidy payments for retirees. So we are expecting those to grow over time. And you can even see here that the liability is expected to peak in around 10 years and then start gradually declining over time. And that's, again, because the system is closed. Now, on the liability side, the key driver of the liability and fluctuations in the liability are healthcare costs, and especially the premium for the lowest cost health plan that's offered to active employees. And so this shows the history of that premium, depending on the type of coverage elected, and the net increase. Now, we have built in an assumption about increases into the valuation, but you can see how volatile that has been over time. And this year, we're actually seeing about a 0.8% decrease for the single member coverage. And that's partly because the lowest cost health plan for single coverage is changing from the Kaiser $3,000 deductible plan to the Anthem $1,500 deductible plan. But it's remaining the Kaiser plan if any dependents are covered. So it's only for single coverage that it changed plans. So for most of the other plans, it's about a 0.5% decrease in the explicit subsidy, the maximum explicit subsidy. We had assumed that that would increase about 8%. So that's a significant gain that we will expect to realize in this valuation on the liability side. All the pre-Medicare plans are affected by that directly. The Medicare eligible plans, the premiums are below the maximum subsidy. So the system here is affected by those actual increases, and Medicare eligible plan premiums decreased between 0.5 and 3.1%. So we'll see some decreases in the liability there as well. So with that background, wanted to look at the assumptions and just give you a quick summary. I think the most significant one for us to look at is really the discount rate this year. And we're suggesting that the current assumption of 6.25 is still reasonable, but it's at the high end of our range. And so you may want to consider a reduction. Healthcare trend rates, we're not making any substantial changes, just update near-term trends to reflect what's going on in the market. No changes to dependent coverage elections. So that slide's actually in the appendix. We're not even going to go through it unless you have questions. The health or dental plan elections, there is a new health plan, so we are making just a minor change to accommodate that. In lieu elections, there's some minor adjustments. And then the administrative expenses, there's a change. So I'm going to take us through the discount rate and let Mike talk about the changes on the healthcare side. So in the pension, we expected a return of 6 5/8. But the asset allocation in the pension trust is different than the healthcare trust. It's a separate trust, and it's smaller and doesn't have as many private asset classes. And so the expected returns are different, and they are lower. And so we compared Makita's 10 and 20-year assumptions to the Horizon survey of the average capital market assumptions in the Horizon survey. They're very consistent. That's what we want to see is just to make sure that your investment consultant is in alignment with what we see other investment consultants. And so these rates have come down. So on the next slide, we're showing the range of the gray bar is the range from Makita's 10-year to 20-year expected return on the assets. And the gold diamond is the discount rate that we used for that year. And so you can see just like we had on pension, 2019 was an outlier because when Makita sets their assumptions in December of 2018, the stock market had dropped significantly and interest rates had spiked. And so everyone's capital market assumptions based on those market conditions changed. But there's been this long trend downward. The current assumptions range from 5.3 to 6.3. So 6.25 is just inside the 20-year expectation. About 40% of the present value of our benefits is paid over the next 10 years and 70% over 20. So we typically would like to see this closer to the middle of the range. And so the current rate still is within that range, but it's at the very high end. And so we think you should consider a drop. We don't like to move the discount rate by a huge step at any one time. And so you may want to just consider a reduction to 6%, but the data would also support going lower if you want. So we can come back to this with the discussion, but I'll turn it over to Mike to talk about healthcare trend rates.
Right, and so from the liability point of view, in addition to the premium changes, the trend really is the other big driver as to what the expected liability is. And what we use to do that is something called the Getson model by the Society of Actuaries. And it really focuses on your initial trends are what your short-term expectations are over the next 4 or 5 years. Then you adjust down to kind of a longer-term trend, focusing on what's inflation, how much GDP growth is, how much medical costs are increasing by more than kind of normal inflation rates. And then you get down to a longer-term assumption that healthcare on a long-term basis can't increase by more than kind of overall GDP, because if it did, 100% of the economy would be taken up by healthcare. And we're not really making any really significant changes. The long-term trend is about what it was last year. We're making some changes in the short term. The biggest change is for the Medicare eligibles. The short term last year was around 6% grading down. We're bringing it down to 4%. And it's really, we've been seeing some changes in what Medicare is doing on the Medicare Advantage side that's really keeping those premiums a lot lower than they have been historically, and that's expected to continue. And then the non-Medicare eligible is a little bit less than last year. We think that the decrease you're seeing this year is a little bit of an anomaly because the carriers are really having trouble adjusting for the care that didn't happen in late 2020 and into early 2021 because of the pandemic and people not being able to get care for anything other than COVID. So we really think it's a really short-term thing that it's going to bounce back. So we don't want to overestimate the impact of that. And then the trend for dental remains unchanged. And you can really see the variations are in the short term for the first 4 or 5 years. That it's slightly higher for the Medicare eligible, then it's really the same after that. And for the Medicare eligible, it's actually slightly lower. And so since more of the experience for a member is going to be in their Medicare eligible years, since that starts from 65 forward, kind of the net impact is going to be really no change to the liability because of the changes in the healthcare trend. Okay, next slide shows where people are actually enrolling. So we show in the first column what we actually used for the 2020 valuation. The next shows where people actually did enroll in 2021. And we show our assumptions. Because if you really look, the actual enrollment is pretty close to what our assumptions were. And again, for 1 or 2 point variations, because it does vary from year to year, we're recommending that we just keep everything unchanged from what we did last year, with one exception, is that they did add a new Anthem HMO. It's the Anthem traditional $20 copay. The difference between that and the one above it, benefit-wise, they're the same, is the Select has a much smaller provider network than the traditional does. And so we're going to estimate that some people will join that plan. So we did 1%. We don't think it's going to be a lot because the premiums are significantly higher. For a single person, they're almost $100 a month higher. And so the retiree would be paying that entire $100 because this plan is way more expensive than the low-cost plan. So we don't think you're going to get a whole lot of people moving. And at the end of the day, it really only impacts the implicit subsidy side of the liability. It has no impact on the explicit because the cost for this plan is more than the low-cost plan, which is really what the explicit funds. Next slide is the in lieu elections, and this is the one where Measure F added the ability that the retiree can waive coverage, and they get a credit equal to 25% of the explicit subsidy for the tier that they qualified for. That they can then, when they come back in the plan, they can actually use that to help pay down their premium that they're paying over and above the low-cost plan. And since this is a new addition, the experience is really limited. Now we have 4 years worth of experience to actually assess what our assumptions are. And so based on that, we're proposing some really minor changes. If we go to the next slide, we can really see that what the chart on the left shows is for active members who go right into retirement. The blue box shows what the actual observed rate was. The gray box around it is our 90% confidence interval. And then the line shows what our historic assumptions have been, and what we're proposing is that historically we've kept it at 20%. You can see it's really varying right around that 20% mark. So for the actives, we're just recommending that just remain unchanged. It seems to be a reasonable emerging assumption that 20% of the new retirees actually are electing to go into in lieu coverage, likely because they have coverage elsewhere, maybe through a spouse, that they're just kind of holding this off to help them when they actually retire later on to pay down any excess premiums. The big variation we see is in the vested term members. And that, again, the same type of chart, but it varies all over the board. Part of it, remember, is this is a really small number of people. So for each year, you're only talking adding another 10 or 15 people. So it's not a huge number, which is probably one of the reasons for the variations. But you can see the first year, it was a significant amount of individuals actually went in lieu. Then in 2020, it dropped down to 20%. Now it's slowly increasing over time. And so our initial assumptions were at 30%. And given that it continues to kind of increase over, and now it's averaging over 40, we're recommending we take kind of a first step adjustment from 30 to 40% of an assumption to kind of take that into account that it looks like it is actually increasing. But again, changing this assumption has very little impact on the liability because this is such a small number of people that this actually impacts. The next slide is the next piece of it is, okay, they're electing to defer coverage, but what coverage tier are they deferring from? Again, it's the same kind of thing. We have very limited data. But what we have been seeing is that more and more people that are taking the in lieu actually are eligible to either cover a spouse or their full family. As we can see, our assumption for the pre-Medicare, the last valuation was 40% would be retiree only, 15% retiree spouse, and 45% retiree family. The actual is only 32% are retiree only, almost 27% of retiree plus spouse, and 41% family. So what we're proposing with this is to start moving towards that direction. So decreasing the retiree only to 35%, and taking that extra 5% and putting it in retiree spouse, and keeping the rest of it in the retiree family. And then we're seeing a similar adjustment for Medicare eligible. So proposing a similar 5%, just moving 5% from retiree only to retiree spouse. And the last piece of this assumption is when we have almost no data yet, which is how long are they going to stay in lieu before they actually come back on the plan? And given very few have come back so far, we're recommending, our initial assumption is we're going to assume they're going to stay out for 5 years, just kind of on average, people were 60 when they were taking in lieu, figured they come back when they're Medicare eligible. And so we recommend to continue just to use that 5-year assumption that after 5 years of being in lieu, they'll come back to the plan and continue to monitor it. As we finally start to get some real experience on that, we may propose some changes in the future. But right now, it seems to be a reasonable starting point, given we have really no other data to go on. And then the last one.
If I can. Why would Medicare eligible, do in lieu unless they were still working? I mean, is there any other reason why they would choose that? Why would they go in lieu? What's the benefit to them?
The only benefit of staying in lieu is you continue to, if you have coverage elsewhere, you continue to accrue that benefit. And you could be in a situation where your spouse is still working and is under 65 and is still covering you. And so in that situation, you can still be covered under your spouse's plan and Medicare would still be secondary. But that's why we're doing our 5 years, is we're kind of assuming that once somebody gets to Medicare eligibility, the reality is they probably aren't going to be covered under another plan. They'll come back into this plan.
Right.
And then the last assumption is the administrative expense assumption. And what the chart on the right shows is what the actual expenses have been adjusted to a current level of inflation. And you can see historically it's been in the $40 to $50 range, but starting in 2020, it's a jump to 92. And that's really a function that the actual allocation methodology used to allocate the expenses between the pension and the healthcare plan changed starting in 2020. And so we're recommending that instead of our historic, looking at kind of the historical average, is that we actually move to reflect the fact that that change has happened. It looks like it will continue to be there. Actually use a $90 per member assumption change, which is more consistent with what the recent experience is. And then it increases in the future years by future wage inflation.
Why is there an administrative expense? I don't understand that. What is that?
That's the cost of the retirement system doing what they need to do. So it's the cost to actually do all of the investments. So it's the investment expenses. It's the cost of Roberto's staff allocated between the pension to administer the pension plan versus administering the healthcare plan. So it's all of those expenses.
So that's charged to the overall.
It's actually charged, right? It's actually charged to the overall trust. And so it's taking those overall expenses. And there's an allocation methodology saying how much of those expenses need to be paid to the pension trust versus the health trust.
And so we do that for both trusts, to the pension as well.
Correct.
Is that, so Roberto, is that a total allocation out of your department to the two trusts, or?
I apologize. I realized I was muted. This particular one is related to the healthcare, and I think, as Mike indicated, I think it does a much better job now to really account for the costs associated by our staff. This one is specifically to healthcare. We do have another one that is included for the pension. You are correct.
But are you 100% allocated out to the two trusts? Is my question.
When you ask, are you 100%, you as in me, or you as in the office?
The Office of Retiree Services, ORS budget.
Well, actually, that I don't know that Benji is here. She will be the accountant with the detailed information. I wouldn't think that we have the whole office attached to it. I know on the pension side, yes. On the healthcare, I suppose that's the case as well. But the bulk of that work is done by the accounting group. But I'm assuming that it does account for costs associated with the work by the whole office on both cases, pension and healthcare.
All right.
I can follow up with the accountant, Julie, and then offline kind of give you a more detailed explanation if you would like. We can do that.
Yeah, that'd be great. Thanks.
Okay, great.
Appreciate it.
Okay, so those are the OPEB assumptions that we need the board to adopt. We summarized the changes back on slide 8. I think the key piece that, well, we would like you to adopt the assumption changes we've recommended, but then the discount rate we left open as some options for the board to consider. You're on mute, Mr. Chair.
Thank you. Sorry about that. Can you tell us for the discount rate, what would the change to 6%, for instance, have on the contribution rates or dollars from the city and from employees?
It will have an increase. I don't have the specific amounts. Because the baseline contribution is only 20 million, it does not increase dollar amount wise anywhere near what the impact is on the pension. Percentage wise, it's a similar increase, although we phase in the impact over 3 years. So it takes 3 years to feel the full effect.
Okay. Well, is there any comment, discussion, or question from trustees on the discount rate?
Are we looking to make a recommendation on a change to this assumption now?
Yes, if that is something you wish to.
Okay, then I recommend that we change our discount rate to 6%. Or I put forward a motion.
Okay, okay, so that's a motion. Do we have a second for that motion? Well, I'll second it for the sake of discussion. And now we have discussion. Is there a strong feeling to lower this or to keep it the same? We saw from Mr. Hallmark that we are currently at the north end of a range at 6.25%, and that our current asset allocation per Makeda, I don't know if we can go back to that slide, is probably in the 6% range for our 20-year return.
Mm-hmm. Plus, I think our investments overall for this particular fund is not as high, you know, in the equity, if I remember.
Right.
This is more conservative.
It's a more conservative allocation.
Right. So thus, I think it justifies a lower discount rate.
Right.
For
I think
that
there was another slide, maybe it was one forward or one back, where we compared it to the expectations. There we go.
And the asset allocations in the appendix, if you wanted to see that.
So based on our current asset allocation, these are the 10 and 20-year 50th percentile is what you've highlighted, expected returns for the current asset allocation. And our liabilities lie somewhere in terms of duration between 10 and 20 years.
Can I ask a question? Can someone please remind me? I think CalPERS recently changed their discount rate. Am I correct? And does
they actually just had a meeting, and they had changed it previously from 7 to 6.8%. This is for the full pension plan, and I believe just this week they reaffirmed a 6.8% discount rate.
Yeah,
that's correct.
But that would not be completely comparable to the OPEB.
Yeah, that's
allocation.
Yeah, understood. Understood. I was just curious. Okay. Totally understood.
I think it might be a prudent thing to take this down to 6% to be a bit more in line with the 50th percentile projections. I believe it has a fairly minimal dollar impact on both the city and employees. And in the interest of prudence, I would advocate that we take the discount rate down a quarter point. You know,
Let me just clarify, it will have no impact on employees. Their rate is fixed.
Yeah.
Okay, so even smaller impact than I just stated, but a fairly minimal impact on the city contribution.
Yeah, Chair Horowitz, before Trustee Jennings' motion and her commentary and yours, I was sort of paying attention. I was a little bit ambivalent, but I think I'm persuaded by your reasoning. So I'm comfortable supporting moving to 6%.
Okay, thank you. Any other comments from other trustees?
I have no objection to moving to 6%.
Yeah, I would support that as well. This is Trustee Keller.
All right, then let's have a formal roll call vote then, and we'll go in order of seniority as we have. Trustee Chandra, do you?
I approve. I vote aye on a change of the discount rate to 6%.
Very good, thank you. Trustee Orr?
Aye.
Trustee Kelleher?
Aye.
Vice Chair Jennings?
Aye.
And before we have the final vote, I should have asked for any public discussion. Are there members of the public who wish to comment? And hearing none, and please advise me if there are any hands raised, because I cannot see that through my particular interface. And if there is no public discussion, then I also vote aye, so it passes unanimously.
So, Mr. Chair, I should have asked this ahead of time, but that motion was just on the discount rate. Can we get a motion on the other assumptions?
Yeah, I was about to do that, just to go ahead and make a motion to approve the remaining assumptions as presented on slide 8, healthcare trend rates, dependent coverage elections, health dental plan elections, in lieu elections, and 115 trust administrative expenses.
Right, we have a motion to accept all other assumptions as recommended by Chiron. Do we have a second for that?
I'll second the motion. This is Trustee Kelleher.
So we have a motion from Trustee Chandra, a second from Trustee Kelleher. Any discussion by trustees? Any comment from the public? So hearing none, we'll have a roll call vote. Trustee Chandra?
Aye.
Trustee Orr?
Aye.
Trustee Kelleher?
Aye.
Vice Chair Jennings?
Aye.
And I vote aye. It is unanimous. Thank you, Chiron, for this comprehensive presentation.
Thank you, and we'll see you again next month.
Looking forward to it.
Take care.
Thank you.
And now it is on to item 5E, if I'm reading that correctly, yes?
That is correct.
And you'll present on this, Mr. Pena?
Yes, sir. Thank you, Mr. Chair. As I mentioned during my oral report, I left my comments regarding the retiree member seat for this item. I just wanted to bring you up to date. You can see before you a reference to Municipal Code Section 2.081070, and that's because we were alerted, we were just recently alerted last week, as was the city, that the municipal code had a section that was, I guess, recent in the code that actually addresses the process for filling and the retiree seat for the board when it happens during the term, which is exactly what happened here. So in other words, there is an actual process when the seat comes up for the regular election time, but if it happens during the 4-year term, there's a different approach. And that approach is stated on that code section, is that the City of San Jose Retired Employees Association should recommend to the board, meaning the Federated Board, up to 3 candidates for appointment for the remainder of the unexpired term. And then the board should interview the recommended candidates and recommend one or more of them for appointment to the city council, so that the city council then can make the appointment for the remainder of the unexpired term. And so the city actually reached out to the city attorney, and they received notification that they need to follow the mini code. And so the city clerk actually stopped the election process for the retiree seat. And just yesterday, actually reached out to the Retiree Association, advising them of this code section, and in the communication, listing 3 names of applicants that were seeking the retiree seat, so that the city, the Retiree Association can look at the application or the information, and then presumably decide who they will be recommending for interview by your board. I'm also being told that the Retiree Association will take this review and discuss it at the next meeting in December. And so ideally what will happen is we will receive a communication from the Retiree Association next month, in time for your board meeting on December 16th, with the name up to 3 candidates for the interview. So that's the latest. Again, the process as it was initially implemented was not the correct one, and the city just changed gears just early this week, and this is the latest. I'm happy to, obviously, council is aware of that, and they have the code section. I'm happy to answer any particular questions that you may have.
So I have a question on that. I thought I heard you say, so I just want to clarify. Did the Muni code section just get changed, or has this been in place?
It's been in place, but it's not, I guess my point was, it was recently changed over the last few years. I don't know the particular year that was implemented. And
okay.
I think the rationale for the change, just so we understand, we're on the same page, is exactly to avoid what was happening. Your board has 7 seats, and that approach is a much more efficient approach to bring candidates forward for appointment by the city council. So I think it was, I don't want to speak for the city. I don't know if Bill Parkman is attending the meeting, but I think that's what the city was looking for, to be more efficient in that process. Obviously, have this process would have been followed, you would have a retiree seat already at your board.
Interesting. So, at our next board meeting, they're going to present the 3 people. Is that it? And then we're going to schedule interviews, or how's?
I do not know who or how many they're going to be recommending. They can recommend up to 3, so they can recommend all 3. They recommend 2 of the names, so just 1 name. It's up to the Retiree Association to do that. Once we get that communication, it's going to be on your agenda for the 16th, and we will then be in contact with the applicant or applicants, whatever many there may be, let them know that there's going to be an interview process with your board.
And is that going to be a public meeting, or
it's a public meeting, just like the interviews that the city council conduct with your public members when they attend the board meetings.
So then do we need to wait until our January board meeting to do the interviews?
No, that will be, the goal is to have it for the December meeting. The goal is to interview these applicants at your meeting next month.
I understand. Okay, I thought they were just going to come to us and say, here are the names and.
No. They're gonna. Well, I mean, I don't want to speak for the Retired Association. My understanding is they're gonna send to me communication on they will be recommending for interview with the board.
Okay.
And then
I
the goal
understand.
is to have those interviews at your meeting on the 16th.
Okay, and then we should agendize that with the city council, so we make sure we're on their agenda to get that.
Well, once your board make a decision, then we'll reach out to the city council so they can agendize it as well, yes.
Okay.
And are you saying there are in fact 3 candidates who've put themselves forward?
The communication by the city clerk to the Retiree Association listed 3 names. That's correct, Chair Horowitz.
Okay, great. All right, well, that will be interesting and also take some time at our December meeting to adequately vet 3 potential candidates. All right, any other questions or comments on the retiree seat? Okay, we'll move forward then to, it says discussion and action, but I guess again here there's no action.
That's right. There was no action to be taken. It was just in case there needed to be some action taken.
Right, very good. So moving forward to 5F, where there will be some action. Nominations for the board chair and vice chair. This month we will have the nominations, and next month there will be the actual election vote for those 2 positions. So does it make sense to take the chair first and then the vice chair?
At your pleasure. That works very well.
Okay, well, I don't know if there's any preliminary discussion or if anyone would like to nominate someone for chair or to put themselves forward for the position of chair. I can tell you it's an exciting and dynamic position that you would all enjoy.
I nominate Spencer Horowitz for chair.
Okay.
I second that nomination. You're just revving up and in like fine form right now. Why would we change mid-course?
Yeah, Trustee Keller would like to third.
You know, I'm put in mind of the old adage that the prize for a job well done is to keep doing it.
Yeah.
And it appears I'm to be punished in that way. But seriously, are there any other nominations that anyone would like to make?
Tag, you're it.
I don't suppose there's a vote to be taken, so we're just accepting nominations. So I guess I am nominated.
Right.
Did you accept it?
You have to, yeah.
Do I have to accept it now, or can I wait until the December meeting?
There'll be a vote in the December meeting.
I see. Well, I guess I accept the nomination.
I guess.
We will see if an insurgency emerges between now and December. Let us move forward then to the vice chair. And let me add just this note. I have been able to maintain a record of perfect attendance up until this date, but I certainly cannot promise that in the coming year. So up until Trustee Castellanos' unexpected resignation, the vice chair position seemed a rather a quiet and uneventful practice. I cannot promise that in the coming year. There may be meetings that will need to be chaired by the vice chair. So with those comments, let's open the floor to nominations for vice chair. Are there any nominations, or would anyone like to nominate themselves?
I would like to nominate Trustee Jennings, Vice Chair Jennings, to continue in her brilliant occupancy of the seat.
And I will second that motion. Or second the nomination, I guess.
Okay. All right, so that is one nomination. Are there any other nominations?
By the way, just for the record, seconds are not necessary for nomination.
Oh, okay, did not know that.
But they're fun.
But they sound good.
Okay, and thirds were certainly overkill. All right, I guess we have a nominee for the vice chair position. Again, final call. Any other nominees? Vice Chair Jennings, do you accept this nomination?
Yes, I do.
All right, then I believe we have completed item 5F. Now we're on to 5G. And I believe Council Chin will address us on this matter.
Yes, good morning, trustees. We've done this a number of times, but to continue to meet virtually under AB 361, the board will need to make certain factual findings yet again to continue to meet for the next 30 days. And so with the backup materials I have provided, we've outlined the supporting factual findings that are evidence that would support the board's factual findings to allow the board to utilize AB 361's continued abbreviated teleconferencing procedures under the Brown Act. And so in your materials, Exhibit A is the governor's continued proclamation for the continued state of emergency due to COVID-19. It's still in place, which is a required factual finding. And two, the San Jose City Council resolution dated October 26, 2021 continues to recommend social distancing in city facilities. Now, I will note that's not in your packet is that the City Council did meet on November 16th and passed another resolution that continues to require social distancing. So that is the most recent resolution on social distancing in the city's facilities. That's not included with your packets, but I can represent to you it's passed. With those two factual findings, if the board so accepts them, the board shall be allowed to continue to meet virtually for the next 30 days.
Okay, so I have a specific script for a motion to be read here. And it says under AB 361, this board, as a legislative body, must make certain factual findings if it elects to continue meeting virtually within the next 30 days. Based on the information presented by council and provided with our board backup materials, it appears that the following factual findings justify the continuation of virtual meetings under AB 361. 1, the governor's proclamation and state of emergency continues due to the ongoing COVID-19 pandemic. And 2, the San Jose City Council recent resolution continues to impose or recommend measures to promote social distancing in city facilities. So do I have a motion to adopt these two factual findings for the election to use AB 361's abbreviated teleconferencing procedure for the next 30 days for this board? Do I have such a motion? We have a motion from Vice Chair Jennings. Do we have a second?
Trustee Kelleher will second the motion.
We have a second from Trustee Kelleher. Is there any discussion by trustees? Any comment from the public? Hearing none, we will go for a vote. Trustee Chandra?
Aye.
Trustee Orr?
Aye.
Trustee Kelleher?
Aye.
Vice Chair Jennings?
Aye.
And I vote aye as well. It passes unanimously. And I believe that completes item 5G. On to agenda items 6, committee reports. The investment committee had a special meeting. I believe that was simply to continue meeting under AB 361, or is there something more to report, Chair Chandra?
No, in fact, I missed the last special meeting, and we'll hold the next special meeting momentarily, and then we will meet for call it a regular meeting on December 21st.
Very good. The governance committee meeting was, again, a special meeting simply to approve the AB 361 requirements. And our next meeting, I believe, is also in December. And that will be a, quote, actual content-filled meeting. And the audit committee, Chair Kelleher, do we have something to report here? It looks like we do.
No, we just had the joint meeting last time, and then we went ahead and adopted the continued virtual meetings.
So the items here under 6.3 A, B, C, D, E, and F, are these for the full board agenda, or are these items for the audit committee?
So BC and D, you can receive and file. They were also received and filed by the audit committee. The big action items, Mr. Chair, are E and F, and they are obviously related to the annual financial audit. Obviously, as you can see, one of them is the actual independent auditor's report, which, by the way, issue what is known as an unqualified or clean opinion, which is the highest opinion available, indicating that the financial statements are fairly presented on the government auditing standards and management. They also include the required communications we will discuss fully with the audit committee. And lastly, on F, the actual comprehensive financial report. You can see it there for 2021 for the pension plan and healthcare, also discussed at the audit committee. The audit committee actually took action in their meeting, approving those E and F. And again, I don't want to speak for the chair, but I would suggest, I understand the committee intention is to recommend to you board to take action and actually approve both item E and F.
Yes, thank you, Roberto.
Okay.
So, I guess we need to approve and accept those. Do we have a motion for that?
I can, should they be separate motions, Roberto?
It
in
should
your-
be separate.
Yes. It sounds like we can take can we take a single motion to accept B, C, and D?
Those, I think, are just a file.
Receive-
Okay, so no actual vote is required.
You can actually receive and file there, by comment, Chair Horowitz.
I see. Well, unless I hear any comments from trustees or the public that would advise otherwise, then I will say we should accept items B, C, and D as presented.
And I'll make a motion to approve item E.
Okay, so we have a motion to approve the reports under item E. Do we have a second?
I second.
And so we have a second from Vice Chair Jennings, the motion made by Trustee Chandra. Any discussion by trustees? Any comments or questions from the public?
Mr. Chair, my only comment is again, I did the same at the audit committee, and I do this annually. This is really a joint effort. The whole, we really enjoy working with Grant Thornton. They do great work. But I also wanted to publicly not only thank Grant Thornton, but also the staff. The bulk of the work, obviously, is by the accounting group led by the accounting manager. But it's a team effort for the whole office. It includes investment benefits, the whole group. And so I wanted to give a big shout out to the whole office, and especially to the accounting group for a job well done. It's not easy to go through a financial audit, and especially on a remote approach. It's the second year they've done that. And I think if you look at not only the clean opinion, but also the required communications, you can see that the office in general did a fantastic job. So again, a big kudos to the whole staff, and on behalf of the boards and the members, I wanted to thank them publicly for the hard work and dedication. Thank you very much.
Yes, and as a city employee, as well as a trustee, and dealing with audits, in my experience, I was very impressed. I mean, it was, pretty much A+ around, and that's hard, in the remote world that we're operating in this time. So I also want to applaud the accounting group and all the other members of your staff that have participated in it.
And certainly receiving an unblemished and unqualified report is something to be duly proud of. And I think all trustees feel great confidence and appreciate that result.
Agreed.
And now we will move to the roll call vote. Trustee Chandra?
Aye.
Trustee Orr?
Aye.
Trustee Kelleher?
Aye.
Vice Chair Jennings?
Aye.
And I vote aye as well. It passes unanimously.
With that, how about I make a motion to approve item F?
Okay,
And that's trustee Chandra.
Trustee Chandra is on a roll today. And do we have a second?
I'll second it.
And we have a second from Vice Chair Jennings. Any questions or discussion on the ACFR? Any questions or comments from the public or from staff? Hearing none, we will have a roll call vote. Trustee Chandra?
Aye.
Trustee Orr?
Aye.
Trustee Keller?
Aye.
Vice Chair Jennings?
Aye.
And I vote aye as well. It passes unanimously. Joint Personnel Committee, the last meeting was April 30th, so I assume there's nothing to report.
There's nothing to report, Mr. Chair, but there is a meeting that has been scheduled for next month, December 7th, I believe, at 1 o'clock. I think December 7th is a Tuesday, if I'm not mistaken, and it's at 1 o'clock. Right now, we still have to put together an agenda for the meeting, but right now it's scheduled from 1 to 3. Thank you, Mr. Chair.
And I'll just comment that I am a member of this committee by virtue of the fact of my chairmanship, but we are restricted by the Brown Act from having all 3 members attend. So my plan is to attend merely as a member of the public and not to act in a voting capacity at that next meeting. And we are not likely to, it's impossible for us to have another member of the board installed by that time.
You're probably correct. I checked with the city clerk, but you're most likely correct that we won't be able to have the appointments before the 7th. Yes.
Okay. All right, on to item 7, education and training. We have the usual Cortex report and a Calipers course. Any comment on that? Any future agenda items? I believe we mentioned a few, such as the retiree interviews in the December meeting. Any further public or retiree comments? And please alert me if there are any hands up that I'm not seeing. So hearing none, do we need a vote for adjournment?
You have that power.
You have that power to adjourn, Mr. Chair. You have a lot more power than you think.
It's a little frightening. Yes, then I adjourn this meeting. Thank you all for attending.